So we are sitting here, it's late January 2026, and if you've opened a newspaper or scrolled through your feed or honestly just walked outside any time in the last couple of years, it feels like the entire world has been absolutely consumed by one two-letter acronym, AI.
It is the air we breathe right now. It is absolutely the zeitgeist.
Exactly. And look, we've covered the chatbots, we've covered the image generators, we've covered all the shiny new software that's supposed to write our emails and drive our cars, maybe even replace us on this deep dive one day.
Let's hope not.
But today, we are doing something completely different. We are not looking at the cloud, we are looking at the ground.
Literally the ground, the dirt.
We're looking at the concrete, the copper, the steel, and the massive industrial air conditioning units that keep this whole global digital brain from melting down. We're doing a deep dive into Brookfield Infrastructure Partners, ticker BIP, and their fourth quarter earnings report that just dropped this morning, Thursday, January 29, 2026.
And this is a fascinating one because Brookfield is, traditionally the definition of boring. They own toll roads. They own natural gas pipelines.
Utility poles.
Utility poles. But this report that just came out, it shows a massive, massive pivot. They are positioning themselves to be the physical backbone of the entire AI revolution.
It's the classic picks and shovels argument, isn't it?
Precisely. While everyone else is frantically betting on which software company wins, is it OpenAI? Is it Google? Is it some startup in a garage? Brookfield is making a much simpler bet.
A much safer bet.
The safer bet. They are betting that all of them are going to need a place to live and just massive amounts of power to run.
And the numbers in this report suggest they might be right. But before we get into the billions of dollars, what is the actual mission for this deep dive? Because I think you, our listener, might be skeptical. I mean, every company on Earth is slapping an AI label on their earnings report right now.
And that's a fair skepticism. The mission today is to unpack how a company known for being conservative, we're talking risk-averse, pension fund-style investing, how they're managing to ride the most volatile tech wave in history without, losing their shirt.
Right.
We need to look at their guardrails, as they call them, and decide, is this sustainable growth or is this just a utility company that's gotten caught up in a bubble?
Okay, let's unpack this. And we have to start with a headline number because frankly, it made me do a double take this morning. We're looking at the data segment.
It really jumps right off the page.
So in their earnings report, the funds from operations, which for those new to infrastructure, is basically the cash flow, the money in the bank for their data segment. It hit $502 million. That is a step change increase of over 50% compared to the prior year. 50%. For a utility-style company, that is. That's unheard of.
It is completely out of character for the asset class. Usually in infrastructure, you're popping champagne if you get 5 or 8% growth. That's a great year. 50% is tech startup territory.
So what happened? Did they just jack up the rent on every server rack in the world? How do you get that kind of jump in a physical business?
It's not just rent hikes, no. It's a combination of two things. First, they bought a massive U.S. bulk fiber network late last year. So that asset is now fully online, integrated, and printing money. So you have that acquisition bump.
Okay.
But the second part, and I think the more important part for our discussion, is organic. It's the sheer demand for capacity.
The report mentions something called lease-up velocity, which sounds like corporate speak for we rented stuff fast.
It is, but the scale is it's hard to wrap your head around. In the fourth quarter of 2025 alone, so just in those 3 months, they signed agreements for 800 megawatts of capacity.
Okay, hold on. We hear megawatts thrown around a lot. Can you contextualize 800 megawatts for me? Is that a lot?
Oh, it's massive. To give you a mental image, a typical nuclear power plant, a big full-scale reactor, might output about 1,000 megawatts.
Right.
So in 3 months, Brookfield signed contracts effectively demanding the power output of almost an entire nuclear reactor's worth of data centers.
Wow. Okay, that puts it in perspective.
And their total development pipeline is now 3.6 gigawatts. That's enough power to light up a major metropolitan city like a Seattle or a Boston, but it's all dedicated entirely to processing data.
But here's where it gets really interesting for me. When we talk about data centers, I think most people, myself included, we just picture a cold warehouse with blinking lights.
Sure.
But the report highlights that it's not just about the building anymore. It's about power-intensive workloads.
That's the key phrase. In the old days of the internet, like 5 years ago, you just needed space and a fiber connection. You were storing photos, maybe streaming a movie. Now with AI, these chips run incredibly hot. They are doing math at a scale we've just never
So
seen.
they need more power.
They need massive amounts of electricity and, crucially, massive industrial cooling systems. It's not just storage anymore.
It's not.
No. Brookfield isn't just renting space. They are selling grid resiliency and thermodynamics. I mean, if you can't keep the chips cool, the AI hallucinates or the server literally melts. Brookfield is getting paid to prevent that physics problem.
Thermodynamics as a service. I like that.
Right.
But this brings us to the elephant in the room. You mentioned the risk-averse nature of Brookfield.
Right.
But 50% growth in an AI-adjacent sector. I mean, that smells like a bubble to a lot of people.
It does. And on the earnings call, you could really hear the analysts poking at this. They're asking, is there too much capital chasing this? Is this going to crash like the dot-com era?
And this is where Uday Madhyaligan, their head of global data centers, he stepped in. He laid out what they call their 5 guardrails. I found this fascinating because it's basically a tutorial on how not to go broke in a gold rush.
It is. It's a masterclass in disciplined execution versus, market exuberance. Let's walk through them because they explain why Brookfield thinks they are immune to a tech crash.
Okay, guardrail number 1, no speculative building.
This is rule number 1 in real estate, but people forget it when they get greedy. Brookfield will not put a shovel in the ground until a tenant has signed a contract.
So no building on spec.
No. They aren't building empty shells, hoping Google shows up. They only build when the rent is already guaranteed.
Which seems smart. Guardrail number 2, counterparty risk.
This is all about who sits on the other side of that contract.
Right.
They only work with investment-grade tech giants, the hyperscalers.
Right.
We're talking about the Microsofts, Amazons, Metas of the world, companies with balance sheets bigger than most G7 countries. They aren't leasing space to Dave's AI startup that might run out of VC cash next month.
So even if that startup goes bust or the bubble pops for the little guys, Microsoft still has to pay the rent.
Exactly. The credit risk is practically zero.
Guardrail 3 was interesting. Workload agnostic locations. What does that mean?
This is subtle but really important. They are building in Tier 1 markets, places like Northern Virginia, Frankfurt,
London, Slough,
which is actually a huge data hub in the UK. But the point is, these are places where the internet lives. Even if the AI boom cools off, these locations still have demand for basic internet traffic, cloud storage, banking data.
So they aren't building a massive data center in the middle of a desert just because land is cheap.
Precisely. It's the difference between buying a house in Manhattan versus buying a house in a boom town that might be a ghost town in 10 years. You want the prime real estate that has utility beyond just the current fad.
Guardrail 4 is disciplined land control, which connects to their self-funding model. We'll get to that in a minute. But Guardrail 5 stood out to me. Capital structure matching.
Yeah, this is the boring financial engineering part, but it's what saves companies from bankruptcy. If you sign a 15-year lease with a tenant, you finance that building with 15-year debt.
You match it up.
You match it up. You don't use short-term debt that might skyrocket in interest next year. You lock in your spread. It's just smart business.
So what does this all mean for the listener who is worried about technology changing? I mean, we're in 2026. NVIDIA releases a new chip every 6 months. What if the data centers they are building today are totally obsolete in 2028?
That is the technological obsolescence risk. And Brookfield's answer is very, very clever. They are effectively the landlord of the shell and the power. They signed 15-year contracts for the power capacity and the cooling infrastructure. They do not own the servers.
Ah, okay. So they aren't buying the H100s or the Blackwell chips.
No. If the chips change or if the servers need to be swapped out because a new architecture comes along, that is the tenant's problem. Brookfield provides the 4 walls and the electricity plug.
As long as computers need electricity?
As long as computers need electricity, Brookfield's asset is valuable. They've completely insulated themselves from the silicon risk.
That is a critical distinction. They are betting on electricity consumption, not on a specific chip architecture.
Correct. It's a very defensive way to play an offensive game.
Okay, let's pivot to how they pay for all this.
Yeah.
Because building 3.6 gigawatts of data capacity is not cheap. We are talking tens of billions of dollars. And they aren't just printing shares to do it. They have this strategy they call capital recycling.
This is the engine of the entire Brookfield model. It's fairly simple conceptually. Buy, fix, sell. They buy an asset, they improve its operations, de-risk it, and then they sell it to a pension fund or an insurance company that just wants steady, boring cash flow.
And then they take that pile of cash.
And they take that mountain of cash and dump it into the next high-growth opportunity, like data centers.
And they had a record year for this in 2025. They sold $3.1 billion worth of assets.
Exceeding their target, yeah.
And the example that really highlighted this for me, and frankly shocked me, was the Brazilian electricity transmission lines.
No, this is a textbook win for them. So let's look at this deal. They built these transmission lines in Brazil a few years ago. They took all the construction risk. They've been operating them. Now the project is mature. It's safe.
And the numbers.
So they're selling the concession. And the numbers are staggering. They are getting an 8.5x multiple on their invested capital.
Wait. 8.5 times their money?
Yes. And an internal rate of return, an IRR of 45%.
45% return on electricity wires. That sounds almost illegal, or at least impossible in a regulated market.
It's incredible, but it shows the value of platform building. They didn't just buy the wires, they built the whole thing. And this is the magic trick. They take that boring, stabilized business in Brazil that's now safe but low growth, they sell it at a huge premium.
And they take that cash.
And they take that cash to build data centers in Chicago or Phoenix that yield 20%. It's the boring business funding the exciting business.
It makes them self-sufficient. They don't have to go to the bank and beg for a loan at 7 or 8% interest.
Exactly. When you can sell a power line and generate your own equity, why would you?
They also mentioned a partnership with KKR and others to sell stakes in their North American data centers. Same logic.
Same exact logic. They build the data center, get it leased up to Microsoft or whoever, and then it becomes a stabilized asset. It's less risky now. So they sell a stake to KKR, take some cash off the table, and use that money to go buy more land and secure more power permits.
This is a perpetual motion machine if you do it right.
It is. And they use this phrase powered land banks, basically hoarding land that already has a permit for electricity.
Which in 2026 is becoming more valuable than gold.
It really is. You can buy land anywhere. But buying land that the utility company promises to hook up to a gigawatt of power, that is the real scarcity. That is what everyone is fighting for.
Speaking of scarcity and power, let's talk about the real-world connections. Because this report wasn't just abstract financial engineering. They gave us specific updates on some massive projects, the biggest one being the Intel partnership.
Right, the semiconductor fabrication plant in Arizona, the fab.
This is a $30 billion Monschool project. Brookfield put up a huge chunk of the money for a 49% stake. For a while, there was a lot of doubt. People were saying, can the U.S. actually build chips anymore?
Is this project going to be delayed forever?
Yeah.
What's the status there?
It's alive. The report says one fab is already in service and producing wafers. The second one is under construction.
That feels really significant because it validates the whole thesis that they can actually pull off these mega projects.
It does, and financially, for Brookfield, they have a $3.9 billion backlog related to Intel alone. And they expect those projects to commission, meaning start paying out cash in the second half of 2026.
So that's a massive revenue wall hitting them later this year.
It provides huge visibility. They know that money is coming. It's locked in.
The other partnership that caught my eye was Bloom Energy. We've talked on this show before about the power grid being so congested. It can take years, sometimes a decade, to build new transmission lines.
Yeah.
So Brookfield is basically saying, fine, we'll just make the power right at the data center. This is the behind-the-meter strategy. Bloom Energy makes these solid oxide fuel cells. They're basically these boxes that sit in the parking lot and turn natural gas into electricity without burning it. It's a chemical process, not combustion.
And the report says they've already installed 55 megawatts of this at a U.S. data center.
And they've expanded the framework to 230 megawatts total. Think about what that implies about the state of our infrastructure. The grid is so slow, so bureaucratic, that it's faster for Brookfield to install their own mini power plants on-site than to wait for the local utility to hook them up.
That is wild. It really highlights that the bottleneck isn't the chips, it's the plug.
And it creates another revenue stream for Brookfield. They aren't just the landlord, now they're the utility company too. They're capturing more of the value chain.
Okay, we've geeked out on data centers and chips and fuel cells. But Brookfield is a beast with many heads. We have to touch on the base business, the stability. Because if AI crashes tomorrow, if the bubble bursts, do they go under?
No. And that's the safety net. Look at the other segments. Transport your rail and toll roads volumes are up 2 to 3%. Midstream pipelines, FFO, is up 7%, driven largely by Canadian natural gas gathering. Utilities are steady.
They mentioned inflation as a tailwind.
Yeah.
Usually, Companies hate inflation. It raises their costs. Why does Brookfield love it?
Because almost all of their contracts are indexed. If inflation goes up 3%, their toll prices go up 3% automatically. Their pipeline fees go up. They get a revenue bump without doing any extra work or spending any extra money.
It's the ultimate hedge.
It is. In places like Brazil, where inflation can be higher, they get even bigger jumps. It protects their margins perfectly. It's why pension funds love this stock.
And they made some quirky acquisitions too, a South Korean industrial gas supplier.
Critical for semiconductors. You can't make chips without ultra-pure industrial gases. So it's another derivative play on the tech boom, but in a very industrial, boring way.
And a railcar leasing platform.
Right. Moving physical goods. Digging into that deglobalization theme-moving stuff around North America requires rail cars. It's all connected.
So let's zoom out. We are looking at the 2026 outlook. CEO Sam Pollock laid out 3 structural themes driving their future. We've heard these before, the 3 Ds, but they seem to be accelerating.
Digitalization, decarbonization, and deglobalization.
So let's break those down really quickly. Digitalization is the AI stuff we've been discussing.
Right. Decarbonization is the shift to clean energy, which Brookfield is huge in. And deglobalization is onshoring supply chains, like that Intel plant in Arizona, bringing manufacturing back home.
These are massive, massive macro trends.
They are super cycles. Brookfield argues these aren't just 12-month fads, they are 20-year shifts in how the global economy works. And they've placed assets directly in the path of all 3. They are trying to be the toll collector for the future economy.
And financially, they seem confident. They raised their dividend again.
A 6% increase. That's the 17th consecutive year of increasing the distribution. For a dividend investor, that kind of consistency is gold. It shows they can fund all this crazy growth, the Intel plants, the data centers, and still have enough cash left over to pay the unitholders more every single year.
And they're targeting a return to 10% plus per unit growth in 2026.
Which is aggressive, I'll admit. But with the Intel revenue coming online and the data center leases kicking in, the math seems to support it. They have record liquidity, $6 billion in cash and credit lines, so they aren't strapped for cash. They have the dry powder to execute.
So if we look at the big picture here, what is the takeaway for the listener? We started by asking if this is a bubble or a backbone.
I think the takeaway is that you can play the AI boom without betting on a single software winner. You don't have to know if ChatGPT or Gemini or some new startup will be the king in 2030. You don't have to pick the horse.
You just have to know that they will all need a stable to live in.
Exactly. Brookfield is a way to invest in the physical reality of the future, whether it's the land, the power, the cooling, or the fiber cables. It's a lower beta, lower risk way to get exposure to high-tech growth.
It's buying the casino building instead of playing roulette.
I like that analogy. The house always wins, especially if the house literally owns the electricity the slot machines run on.
Before we sign off, I want to leave the listener with one provocative thought that came up in the Q&A of the earnings call. It's a concept I hadn't really considered. Sovereign AI.
This is a huge sleeping giant.
So Sam Pollock mentioned this. Right now, we focus on the hyperscalers, Amazon, Google, Microsoft. But Brookfield seeing nations, entire countries, wanting to build their own AI ecosystems.
Think about it from a national security perspective. If you are France or Japan or the UAE, do you really want your country's critical data, your government intelligence, your citizens' medical records running on servers owned by an American company in Virginia?
Probably not. You want control over that. You want sovereignty.
So these sovereigns are coming to Brookfield and saying, build us an AI factory inside our borders. We want our own data sovereign capability.
And while governments move slower than tech companies, the checks they write are massive.
And the contracts are incredibly secure. If a nation-state signs a 20-year contract for data infrastructure, that is as AAA as it gets, you aren't worrying about them going out of business.
It's a whole new layer of demand that most people aren't even modeling yet. It moves the conversation from commercial convenience to national necessity.
And that is a very powerful growth driver. It turns data centers into critical national infrastructure, just like bridges or dams.
A fascinating look at the plumbing behind all the hype. That wraps up our deep dive into Brookfield Infrastructure Partners Q4 2025 earnings.
Always a pleasure to dig into the details.
If you enjoyed this, do us a favor. Next time you see a data center or a transmission line, give it a little nod of respect. It's doing the heavy lifting while the chatbots get all the glory. Thanks for listening, and we'll catch you on the next deep dive.